of SPACs that have sort of reloaded the supply in the market. Having a good, healthy number of SPACs with full lives, full trusts, et cetera, out there on the hunt, I think is super helpful. Having a number of repeat SPAC sponsors who know how hard it is to get a deal done come back into the market is also a really encouraging sign, I think, for the industry. But that's the supply side. And what we want to talk about a little bit is how to regenerate the demand side. And in particular, demand from higher quality companies that look at the SPAC path as a very appealing path. It's no secret, and there was some great data last night, but it's no secret that the IPO market, the regular way IPO market, has been challenged for a good number of years. Despite the recent buzz, the fact that it's only a few dozen, I'll say, higher quality companies that have fit through that door over the last, we're halfway through the year, so over the last 6 months, that's not enough, frankly. The idea of getting higher quality companies to really pay attention to the SPAC path, I think, is the challenge for everybody in the industry and in this room. And that's the topic that we wanted to cover today with this panel. We did put together a very esteemed panel, experts from banking, legal, SPAC advisory, SPAC sponsor community. So maybe what we'll do is we'll just roll into some quick introductions and then roll into the questions. Joel, you want to start?
Yeah, hi, good morning. I'm Joel Rubenstein, a partner with White & Case. We're an international law firm, and I've been working with SPACs going back to about 2004, 2005, so I've seen the arc. I've been actually sponsored this conference, I think, since 2006 or 7, remembering at times when it was in a little room in a hotel, dingy hotel. But it's great to see everyone here. We've worked on hundreds of SPAC transactions all through the cycle, IPOs, business combinations, and representing SPACs, representing target companies, and representing investors.
Great, thanks, Joel. Kareem Manani, partner, leads EY's transaction practice globally and in the Americas. We've been working in the SPAC market since 2012. Our first deal we did was with Joel and his partners, and we've been active ever since. We've been through, we're mostly focused on the de-SPAC side. On the advisory side, we've been through 250 plus de-SPAC transactions, and really glad to be a sponsor of this conference going back to 2017 or so.
Thank you. I'm Jim Graff. I'm the CEO of Graff Global, which, despite its name, is really focused on U.S. opportunities. This is my 8th SPAC as a sponsor or non-independent or lead director. So I've been in this for full-time for about 14 years, actually. Worked with Joel and Kareem on our first deal back in 2012, and have known Tina forever, so we've all been working together for a long time.
Thanks, Jim. I'm Tina Pappas, Managing Director at Jefferies. I run our SPAC business out of Equity Capital Markets, and I've been involved in the SPAC business since 2005, dedicated. I worked on a 90s era SPAC transaction long ago, but I don't count that. So nearly 200 closed SPAC transactions in that time, and Jefferies, unlike some of our other peer firms, has remained active and committed to the SPAC product throughout the time I've been there.
Appreciate all you guys being here. So, Tina, I'm going to start with you. Aftermarket performance has obviously been very challenging as one of the main issues around town. If you take a look at closed de-SPACs over the last couple of years, I'll say averages are trading at a fraction of the $10 price. What needs to happen, in your opinion, in the market for aftermarket performance to begin to improve and for investors to begin making money on these deals?
Yeah. So it's not going to be the most insightful comment, but we've had the last couple of years, the beauty of the SPAC product is that you can transact to take a company public if the SPAC sponsor and the target are willing on some basis. Now, many transactions have closed with subscale businesses that, are not what I call, they're transactable, but they're not investable, meaning that fundamental equity investors aren't attracted to that story. It could be too early, it could be too small, it could be something where the valuation has not been compelling to investors. And so those transactions closed, maybe they raised a small amount of capital from parties around the table, friends and family of the target, existing shareholders, the SPAC sponsor, some of the investors around the table. But ultimately, the terms of the transaction didn't clear the market. And that is what really needs to happen in order to see deals trade better, because, as I said, many of these companies probably don't belong in the public market, and maybe over time they will grow into being an investable company. And as I said, that's the beauty of the SPAC product, that a company, if it really wants to be public and have more financing options as a public company, you can transact with a SPAC. And all parties going in with eyes open as to the challenges, the potential illiquidity and the potential to trade down very substantially below the $10 kind of reference price. What we're seeing now, and it's very early days, these things go in cycles, as some of us have been around the product a long time have lived through. Investors are starting to be more open to both the SPAC, de-SPAC equity, as well as pipes. It is very idiosyncratic, and there's still a lot of investors that kind of have a knee-jerk negative reaction to the word SPAC. But the quality of the companies that are thinking about a potential SPAC exit, really in the last few months since the market volatility increased, has gone up a lot. Most of those deals have not made it to be publicly announced yet, but we're definitely seeing green shoots, and it's very encouraging.
Setting that initial SPAC valuation is obviously key to the aftermarket performance. Fortunately or unfortunately, in IPO land, structurally, IPOs are set up to work, and they're set up to work in the aftermarket based on that initial valuation. It sort of seems, especially in the last couple of years, that SPAC deals are really structurally set up to trade down in the aftermarket. Jim, as you're going through your processes and thinking about valuation and setting that initial mark, how do you think about setting valuation?
Yeah, on valuation, I wouldn't necessarily say that a lot of these recent deals have been overvalued. It's that there was no market clearing price. When we haven't cleared the market, we're talking about common equity, long-term fundamental investors. So if you can't, if there's no price at which these things can be sold, so much structure has gone into these deals with downside ratchets, et cetera. So, I also think it's a little sort of misleading to say everybody's lost money on SPAC deals over the last couple of years, because, I haven't seen the analysis, maybe somebody has it here, to see the returns for those PIPE investors who had the structured deals, who, took the risk, came in, got the deals through closing and funded it, and benefited from downside protections or ratchet or extra warrants, because I would suspect that there have been some attractive returns for those who have funded those deals. Now, to your question about how we look at things, just looking at the different things we've looked at over the last couple of months, there's probably 3 different approaches to valuation. One is the old-fashioned way, which I prefer, where you look at current year profitability or EBITDA, or maybe 1 year forward, and you apply a reasonable discount to the comparables trading in the market. When we had done Williams Scotsman back in 2017, there was a comp trading at 12 times. We priced it at 9 times, and there was a discount, based on current year numbers to the comp in the market. So that would be the ideal scenario. We're not seeing many of those, but that would be the preferred choice. most scenarios are situations where you may be a year or two away from profitability. You can't, or we don't take the view that we can provide projections out more than maybe 1 year. So we would look at scenarios or different unit economics, and that's where it's critically important to focus on the key value drivers, to be able to look at a complicated financial model and say, what are the 3 or 4 things that are going to drive valuations, and you work out multiple different scenarios to see how it may play out and how you can guide investors to build their own model and use their assumptions. And I would say the third approach that we are less comfortable with, but is happening in the market, is the pie in the sky. It's the stories, it's the memes, it's the things that sort of excite investors, not necessarily fundamental investors. And that really is a matter of what the market would bear. And you are seeing deals that get done that don't use any real traditional valuation, but it's just based on pie in the sky, what people would pay for that story today.
Let me get your reaction to this, Jim. So it feels like in markets past where sponsors are competing for assets and trying to get companies to, I'll say, go over that line where they haven't been willing to go before, it feels like some of the headline valuation numbers are being used by sponsors almost as a, I'll say, a quick fix to push them over into the transaction, regardless of kind of longer term consequences of that. You agree, disagree?
It's certainly been done. Well, people will say, let's give it a shot at some crazy high valuation. We haven't seen that work out very well. I always think it's important to test the waters, talk to investors, talk to analysts, to get a sense of whether the story is going to fly at the valuation. We've actually lost business because some sponsors are willing to just sort of throw it out there and see how the market responds. I'm really a believer that if you've got good relationships with your key investors and fundamental investors, and you've got good advisors, you should be able to test the waters and get a good sense of whether the deal will clear the market.
Discipline,
Just one point on that. I think there was this idea of a SPAC off back in the day, right, where you'd line up all these SPACs and everyone would.
They're back.
They may be back, but I hope that people at least are being a little more discerning. It wasn't so much as like there. It's like, I'll offer you $1 billion, or I'll offer you $2 billion, I'll offer you $3 billion, sold. And obviously, you're really not negotiating against a SPAC. You're negotiating against the investors and what they're willing to pay. So it looks like you've got a counterparty who's offering you something, but in the end, as Jim said, you need the investors behind to back it. So, I think people are a little more savvy now about that and realizing, and in fact, in one situation where we're on the target side, they put out kind of a SPAC off, but they pretty much telegraphed what they were looking for in valuation, and they weren't looking for people to come in and try to offer more and more and more. They were understanding of what they could command, and they were looking to differentiate SPACs in other ways.
Discipline, discipline, discipline. That's got to be the mantra going forward. Kareem, bring you back into the conversation. I know you see a ton of different structures, a ton of different provisions in these deals. Are there certain things that you're either seeing in today's market or would like to see in today's market that you think will benefit the SPAC product and the SPAC path in the future?
Yeah, I would say I'm a big fan of aligning kind of the SPAC sponsors' interests with that of the company. If you have a marriage that is a win-win for both and the interests are aligned, those deals trade better, you can raise capital, and post de-SPAC, the companies perform. If you're at the odds, Joel just said, if you're doing a SPAC off and just looking for a financial sponsor to put money in and just take the carry, sometimes, you're at the odds with the company you're merging with. I think you kind of do that with kind of aligning the economics of the sponsor with the capital raised. You have to right-size the fees on the transaction with the capital raised and the size of the valuation of the company. And the goal is to keep as much money in trust as possible for as long as possible. How do you align interests? Having springing shares, you've got earnouts that have been utilized for a long time to kind of get the parties to be on the same page. And then really thinking about kind of the banks that underwrite the IPOs, like taking their fees on a deferred basis, right-sized on the back end here. I'd also say SPACs that have automatic extensions in place, because sometimes it takes a little bit longer to de-SPAC, could make a world of a difference of a deal closing and maintaining capital versus kind of going out, getting a vote, getting redemptions and like. So thinking about it holistically, I think will not only drive alignment, but actually signal strength to the market more.
Joel, what about on the regulatory side? New regime down in Washington. What do you think they either could be doing, should be doing? What's going to help facilitate the product over time?
So as Doug said in his opening remarks, we're definitely seeing, no surprise, a different attitude from the SEC, and that manifests itself in a couple of ways. When we've engaged with the staff on issues, things which have, let's say, gone up to higher offices, the Office of Chief Counsel, et cetera, we're definitely sensing a much more even-keeled approach, less pushback, more openness to engage with us, which I think is very helpful. So I think overall we're seeing that greater positivity. We're seeing faster turnarounds on things when things really slow down, particularly there's a cadence. You get your first comments, but on your second and third comments, they were being very slow. We're definitely seeing a lot faster cadence on that. So I think there is some positivity. And the other thing is, and as I think Doug mentioned as well, the SEC is being bombarded, I think, from a variety of directions with a lot of people with ideas of either rolling back some of the rules or even just some of the things that they punted on in the rules. So, for example, the infamous Rule 144I, which is basically something that keeps de-SPAC companies forever tainted with this idea that they have to have current public information for be able to sell under Rule 144. And the bottom line for that is that it creates issues with being able to ever take off legends from securities, and investors don't like it because in the end of the day, it's all about getting investors to come in and want to buy and be able to monetize afterwards. So a lot of people are putting in letters, other approaches to the SEC, and we're definitely hopeful that there'll be a greater openness. I think the other thing was Chairman Atkins has said very clearly that part of what he's trying to do is clear up old rules, other things that are not accomplishing anything. I think we were in an era before now with bloated disclosure, and so another thing Doug noted, this net cash or the dilution tables on the cover and a cover page, which is now multiple pages going on and on, really facilitates nothing for investors and just confuses everyone. So we do see positivity, and we're hopeful that there'll be a positive reaction from the SEC.
So Joel mentioned expediting transactions, and we all know time kills deals. One of the, I'll call it, continual sticking points in these transactions is the generation of financial statements and getting to PCAOB audits. So for Kareem, if there's any sort of best practices around expediting that work stream, getting companies over the finish line quicker and hopefully with better deals, what would you say?
It's actually interesting. I mean, from the beginning of time, you'd have thought that the auditors could accelerate the audits. At the beginning of the SPAC world and transactions, that was an issue. It continues to be a predominant issue that needs to be kind of tackled very early on in the de-SPAC process, especially if the company is, one of these high-growth, emerging growth companies, hasn't really focused on their financial statements, getting audits, having an auditor that's PCAOB accredited in place. There's a time commitment to onboard an auditor and then get them through the transaction. So I would just say, look, proper planning, ensuring you've got a reputable advisor, especially on the accounting side, to handhold out the auditor kind of through all the complexities that come with a transaction, stand behind the management team, particularly the CFO, CAO, controller, and supplement them, makes a world of a difference. It brings confidence to the close, and it actually enables the management team of the operating company and the SPAC sponsor to focus on marketing the deal, raising capital, and operating companies so they can de-SPAC successfully.
I've always found the best practice is to have the first call be to Kareem, Alex, and their team to assess whether the company is what's the time, effort, and expense to get to the audited financial statements. Because
Yeah, and I think as part of that, one of the important things to do is to identify what you need, and sometimes when you have multiple targets, particularly, that can be complex, and you can go to the SEC, and we've done this in a number of deals, working with Kareem and others. You can go proactively to the SEC, Office of Chief Accountant, and get them to bless your approach, and doing that early on greatly speeds the path through the SEC process.
That was the promotional part of the show.
But it was also, whether it's EY or somebody else, I mean, I think we've seen over the years, more deals have died because of the inability to get the PCAOB compliant financial statements either timely or cost effectively. And the worst thing you can do is spend 6 months on something and then have and this has happened to us, where we've been down the road on something and then they say, well, we just can't get the financial statements, or we're not going to start working on them until we know we've got the pipe committed, and then you're not filing your S4 until 4 months after announcement, and you've lost all momentum.
Yeah, I'd say one last thing. Some of the companies that have gone through the SPAC process over the last decade have been cutting-edge companies. Think of like the EV kind of boom. Then we had the gaming boom. Then we had, self-driving cars, LiDAR. There are very unique companies with new business models. And so how you generate revenue in particular and how you monetize hasn't really been thought out in enough depth. And so getting an auditor to kind of agree to specifically novel, new RevRec models takes a lot longer time and can impact the model, how revenue is recognized, and how you market the deal. So if you are looking to SPAC or de-SPAC a company that is in a new area that doesn't have much precedent, that process needs to be vetted and actually adds more time to getting those financial statements kind of signed off on.
And I'll jump on the bandwagon. Oftentimes we get to a point where we have LOIs where parties are under exclusivity. They have timelines and deadlines for financial statements, and we get in there and see the state of the finance organization, the state of the books and records, and we just know right up front there is no way in heck that any of that is happening. Anyway, I want to turn back to the market and trading side and come back to Tina. We're all watching a steady stream of these low float situations where de-SPACs are closing, very few shares remaining out there in the public markets. Stock prices are erratic. They're zooming up and down. And frankly, investors are unable to accumulate positions in these companies. So, Tina, for you, how big of a problem is this, and how does it begin to rectify itself?
Yeah, for sure it's a problem, and many banks and investors have gotten calls from some of these companies trying to solve their capital structure because, as you say, many of them have no float, and unfortunately, some of the financing options that they have are limited as a result. And we've turned away some situations where we thought the company is interesting, but we couldn't kind of achieve their objective or help them achieve their objective. So I think it just comes back to, making sure that when you construct the transaction between the SPAC and the target, that there's at least some core shareholder base that the company is establishing in the transaction, and that investors have a long-term view on that business. It sounds super basic, but there's been many transactions that we've observed, even deals that are currently announced, where we took a look at the situation and saw that they would struggle to raise the amount of capital needed to finance the business to cash flow. So it's kind of back to the basics. You have to be, or at least have a plan to be properly funded as a public company. So any company that's considering going public with a SPAC in addition to like the IPO readiness. Like you have to have a plan to engage with shareholders that, you know, are aligned in terms of the fundamentals of the business. And unfortunately, too many companies kind of rush to the market. They do a deal kind of highly structured with investors that are not really pricing the deal. They're kind of buying a structure. And then those investors are not long-term investors. They're buying the structure, and they're going to look to, you know, to trade out as soon as they've kind of locked in a return. And once you de-SPAC that type of, once you're in that situation and you've de-SPAC'd, you kind of have to go back to the beginning and kind of re-IPO those companies. And we're seeing that, and we've worked on a couple of those situations where you have to kind of just start from scratch, find just this sort of fundamental shareholder base, and hopefully those companies over time will season. And we have seen a few of those actually do quite well over the years that kind of work their way out of the low float situation. But there's no easy fixes, unfortunately. There's no silver bullet.
And I think suffice to say, if you close a de-SPAC transaction and your only public shareholders are the 400 or so round lot holders that you need for exchange listing, it's going to be a long process to get back to regular way, publicly traded company with investors, true long-term investors that will back your story. No quick fix. Staying on the investor side, pipe market. Jim, any thoughts on how we start to see it get unstuck, how we start to see fundamental investors coming back into the pipe market?
Well, I don't know if they were ever there in the first place. How many fundamental investors are in the room?
Nobody's admitting.
Exactly. There we go. I want to talk to you. A couple of things that, you know, we have had deals where we brought in fundamental investors into a pipe or to buy shares into the market. You know, I think some of the things that have held them back, from what we understand, is one is scale. You know, fundamental investors not going to want to spend the time and effort unless they can put 10 or 20 or 30 million dollars into a deal, and they're not going to want that position to be more than, say, 5% of the actual public float to have liquidity. That means you're going to need to have 300 million, 200, 500. You're going to need to have several hundred million of public float to attract, you know, to have the kind of liquidity that would attract most fundamental investors. And, you know, float, that's not market cap, that's cash left in trust and pipe. And how many deals over the last couple of years have closed with $300 or $400 million of net proceeds? And so until you start seeing transactions that close with $300 or $400 million, I think it's going to be difficult to get fundamental investors in. The second thing is, you know, there needs to be, I think the fundamental investors we've talked to, you know, most of these SPAC deals are a little smaller. You know, nobody wants to get up the learning curve for one standalone deal. So if it's a sector where you've got institutional investors having 2 or 3 positions, if you've got analysts who cover the sector, it's much easier to get them to spend the time and effort to learn about this and to make that longer term commitment. I think the final thing I'd say is, you know, the structure in a lot of these deals is scaring away fundamental investors. You know, nobody wants to be holding common equity for the long term if somebody's got full ratchet protection, you know, on the downside. And, you know, we've benefited from those deals, and so it's something the sponsors have to weigh, you know, the structure you need to do to get a deal closed, and, you know, having a cleaner structure that's going to attract more fundamental investors. You know, I think the key consideration for everybody, you know, in the back end of the deal is what Tina said, is having enough cash at closing. You know, if you're into a situation where a company needs $300 or $400 or $500 million to get to profitability and you're only raising 100, those fundamental investors, even if they like the space, know you're going to have to come back to the market in 6 months or a year or 2, and they might just wait until then. So if you can say we're fully funded till closing, we don't need to raise, you're not going to have another bite at the apple a year from now, and you know, and it's sort of sizable enough, I think you'll see more fundamental investors come back.
And we did a pipe early last year. I think it's one of the few that are trading at a significant premium. It was in the energy sector. And we saw investors in that deal, it was over $400 million pipe, common at 10. And we saw investors that had not participated in a pipe in 3 or 4 years, some large long onlys, and they made an exception going to their committees because it was a very unique situation. I can't name names, but many of you can figure it out. The CEO was a well-known operator that had run public companies. He was making a bet, but the valuation was extremely compelling, where as if they were able to execute on that plan, the returns for investors were obvious. So and we were even seeing that in sort of the traditional IPO world, where investors are very open to hearing new stories for the first time in a long time, but they're very, story dependent, and valuation has to be very compelling. So that phenomenon that we saw in 2021 of, just sort of putting out transactions at valuations that were astronomical is not going to be a recipe for success, coming into this cycle of the market.
And I'm glad you brought it back to valuation. I think it's probably fairly consensus that if we have good assets at the right prices, the market just works. If we don't, it's going to struggle. Last couple of minutes, Joel, I'm going to give you a little bit of time, and if anybody else wants to chime in as well. Your views on what SPAC market equilibrium looks like. What does it look like when we get to a path for companies that's constructive, that's, I'll say, the right path for companies, at the same time creating an investable asset class for investors?
Yeah, look, I think the theme you're hearing here is everyone just needs to live in reality, right? You could want to have fundamental investors all you want, but they're only coming into certain deals, and there are going to be deals in the market. So I think you have sort of different things. We've done a couple deals recently. Last year, Lionsgate deal, which had a sizable pipe. We have a deal right now that's going through the de-SPAC process, which has a $260 million pipe in the life sciences area that's all fundamental investors, and it's particular to the life sciences area, and that's all common stock. But I think every company has to assess for themselves what really makes sense, and if the need for cash is what you really are focusing on, you can't get hung up so much on valuation, et cetera. The market will tell you what the valuation is. And by the way, one of the things I think we've seen in the market, kind of a difference in deal terms which hadn't existed for a while. It was always a unit with a share, some form of a warrant, and then some of the deals additionally had a right. Now we're seeing, right, there's some deals that have a warrant component, some deals have a right component. I think, there's different philosophies on the warrant, right? Some people look at it on, let's say, we're looking at large companies, big companies say, I don't want to have that kind of going on in my cap table after I close. On the other hand, we've had companies recently that have had warrants, and they've done warrants in their pipes and things like that, where they've taken in significant capital after the closing. And going back in the day, when I started doing this, the unit used to be comprised of a share and 2 warrants, and the warrants were struck in the money. And the whole idea was for companies to be able to raise capital efficiently without having to go do a marketed offering and pay bankers again, right? Nothing against bankers being paid. And we're seeing that now where, the warrants for the right company can be really powerful. And by the way, that also helps with the float. You're getting more common stock out there as the warrants are exercised and more money into the company. And if that's coming in at a lower valuation than you wanted, that's what the market has said, but it's going to allow you to grow your company and do that. So I think it's all about living in reality, recognizing where things are. I think the frothiness is definitely gone. You still see people who unfortunately get taken in by these super high valuation situations and feel like they believe it, they want to do it. And I think the market is going to hit them with a large dose of reality, but I think we're seeing fewer and fewer of that, and I think that's going to really make the whole SPAC market much more positive for the future as people live in reality.
So I think we need to wrap it here. Thank you to all of you. We truly do appreciate the opportunity and enjoy the conference.
Okay.